Most people I have met have most of their assets in the market, and they're very happy about the upside volatility. They love the growth, but they have forgotten what it's like to lose your money. They have forgotten what it's like to be in a 2001 and '02 situation, which is a very normal situation for a market crash, or a 2008 financial crisis where it goes down very sharply, where you think the banking industry is going to collapse. The pandemic wasn't really that big of a market crash. It was a quick crash, but we printed a lot of money, so it recovered quickly. Welcome to How to Retire on Time, a show that answers your retirement questions. My name is Mike Decker. I'm a licensed financial advisor and fiduciary. And with me in the studio today is my colleague, David Franson, who will be reading your retirement questions. As always, you can submit those questions to 913-363-1234. Again, that's 913-363-1234. David, what do we have for today?
Hey, Mike, I am comfortable taking risks, even in retirement. For people like me, what type of portfolio would you recommend?
The first thing we need to address is the misnomer that more risk equals more reward. It's potential reward. And if you have a long time horizon, then yeah, being more aggressive can be helpful. Ray Dalio, a very famous fund manager, once said that unless you're aggressive, you're not going to make any money. But unless you're defensive, you're not going to keep any of your money. And the misnomer is in retirement that you're going to make money by taking more risk. It's not necessarily true. And it's really based around, I don't want to say the sequence of returns risk. That's kind of a side thing that's often talked about income. What I'm talking about more is volatility. So, I mean, David, before you worked here, did you have a clue what the word volatility even meant? I mean, just think back before you were educated in finance.
Right, yeah. I mean, maybe not in the financial context. And, I think we knew basically what volatility meant, but as it applies directly to the markets, your personal finance, maybe not. And sequence of returns risk is another sort of
It's just
what
Greek.
is that?
Yeah.
Okay.
So let's define volatility is the movement in the market. Okay. We like volatility when it's good, as in when it goes up. We don't like volatility when it goes down, but you can't have your cake and eat it too. So when you've got a shorter time horizon, then volatility or the bigger movements up or down can be good or they can be bad, but you don't have time to kind of let things average out. So for example, if you had, let's say, put money into the S&P 500 in 2000, there was a lot of volatility, a lot of ups, but also a lot of downs, and you ended up with around zero returns over a 10-year period of time. Now, from 2010 to 2020, you'd have averaged around 14% year-over-year returns. That's good volatility. But no one knows the future of volatility. Okay, are you with me so far on this?
I'm with you, yeah.
It's the roller coaster, and roller coasters go up and down.
Yeah. Oh,
Okay.
so make some fun, right?
Yeah.
Maybe not when it's your life savings, though.
Yeah. Well, it could be, but yeah, no, not really. It depends
Okay.
on what you're looking for.
Sure.
Now, the second part is, well, if I just hold on to it long enough, it should recover. You've got to have, in my opinion, a 15 to 20 year period of time for that really to make sense. When you retire, it's not about shooting the moon. It's not about trying to really, really grow your assets. If you need the money, you've got to lower the volatility and increase the predictability. Notice the difference there. We might be lowering the volatility, the ups and downs of the roller coaster, but we're increasing predictability, okay? So let me give an example. You could be invested in a bunch of stocks. They go up, they go down, and you hope overall they go up, but it's not certain. And they can go up as much as they want, right? Look at Palantir and what that's done. That's insane. But Palantir in the beginning of 2025 also had a 40% top to bottom. Can you stomach that? And what would that average out to be? So these are things to look at. Supermicro company also, a very highly volatile stock. They've got huge swings going up and down. And then you've got other stocks like Costco or Walmart, or I would even throw it like Apple isn't as volatile as it may be because it's not incredibly high growth. It's just more, it's slowed down a little bit in its volatility or its breadth. That doesn't mean it can't have big swings. It just means it's maybe not swinging as big as it did originally. Are you with me
Okay.
so far?
Yeah, it sounds like the sort of the big established players, Costco's, Walmart's, Apple's, their sort of peaks and valleys are much smaller.
They're just more predictable.
Okay, yes,
They're more
yes.
steady businesses. I mean, look at Coca-Cola.
Oh, yeah, yeah.
Do you think they're going to do you think AI is going to revolutionize the enjoyment of a bubbly beverage?
I can't imagine that it does.
So, you can still grow your wealth with more predictable stocks as a part of your portfolio, but maybe that's not what you want to do. That's fine. But do you see the trades here of just predictability versus bigger swings? Because when you need the money, it's got to be there, and you can't draw income from assets that have lost money. Now, let's continue down this path. Let's look at bond funds. Okay, bond funds are less risky or less volatile, technically speaking, than stocks. What does that mean? They've got less growth potential, but they shouldn't lose as much money either when things go sideways. But bond funds can lose money. Well, what if we looked at something a little bit different? What if we looked at something like a buffered ETF?
Yeah, explain that.
Yeah, so a buffered ETF is basically a very fancy ETF that uses contracts to give the investor up to typically, let's say, like around 7% of the upside of the S&P, for example, and rates will always change. But let's say you get the first 7%, that's called a cap. So you get up to 7%. Anything above that was a contract that was sold, someone else got those gains. But you can't go backwards. So if you hold it during the duration or that 1 year period of time, if the market's tanked, you don't lose money, it resets, and now you've got the next year for that up to 7% growth. So do you see how there's still upside potential? You still could grow your funds, you could still grow your money, but you can't go backwards. You have locked in your gains, as they say, as in you've sold some of your assets. You can't go backwards. You're still trying to make money, but you're okay not trying to make the most money. Now, should all of your portfolio be in that? No. One of the biggest red flags is if all of your portfolio is in all of kind of the same thing, that is kind of, I think, an oversimplification, maybe an overgeneralized or a risky portfolio. That's just my opinion. But what if you had a part of your portfolio that couldn't go backwards? Do you see how you're now maybe giving up some of that upside potential, but you're significantly decreasing that downside risk? So you're kind of moving a wild roller coaster into a roller coaster that you could handle, that still has reasonable upside, that still is going to fit your legacy goals, your lifestyle goals, keeping up with inflation, outpacing inflation, things like that. Do you see the difference here?
Yeah, absolutely. I think I do. That yeah, it sounds like you're saying that when you're going to need those funds like early in your retirement, right, to draw income, and so we don't want them, losing too much too soon, because as I think I've heard you say before, if you're drawing income from an account that has had losses,
You accentuate those losses,
yeah,
makes it more difficult to recover.
right,
Okay. Now let's talk about averages and how they can be deceptive. Okay. So let's say your portfolio is a very volatile portfolio. Let's say you've really purchased some nice stocks, but they're volatile. Okay. High beta, you could say, if you're familiar with the term or looking it up on your
yeah,
Morningstar reports.
okay. Some
So
industry terms there we get to learn about.
yeah, look them up. They're interesting. But um, let's say you look back and this year it did, X percent. This year did X percent. The next year did X percent. And you put them all together and you do a simple average, and you say it's about 10% is the average that you would expect.
Okay.
Okay, well, what does that really translate to? If it's like 9% 1 year, then 11% the other year, do you notice how the returns are close enough to each other? Then the 10% kind of makes sense. The larger that variation gets,
Mm,
the less accurate that average is going to be. So let's do an exaggeratory example. Let's say that you're going to get 30%, or no, let's do 50% in 1 year, but a 30% crash in the next year, which can happen. 30% crashes can happen. I don't remember a time where the markets made 50% on their own, like at the S&P 500, for example. So if the markets go down, let's say 30%, and let's say you have $100,000 invested, you're now down at 70,000. And then the markets increase by 50%. You've averaged 10%, but your cash value is at 105%. The cash value growth was really about 2.5%.
mm,
So do you see how the increased volatility, the increased exposure to the market might not always work out to your favor when you're looking at shorter time horizons when it comes to income planning or distributions or withdrawal rates. It may not be as effective if you're looking at legacy planning, charitable gifting, or just moving funds around for your lifestyle and legacy purposes. But if you had, 9%, 11%, 10%, 6%, if the averages are kind of in the same, there's a more predictable range, then it may make sense.
Sure.
Do you see the difference there?
Yeah, we want to keep things within a range, I guess, that we're comfortable in. And if there's a track record of it staying sort of similar, then we can hope that continues.
And the most important thing that you could really do in this exercise is to not let greed take the wheel. Let me tell you a quick story.
Does it involve Gordon Gekko?
No.
Oh, okay. Well, continue on anyway.
Yeah. So when I was, I think, 11 years old, my family we were going to Lake Powell for a nice kind of family boat trip, right? Lake Powell is in southern Utah, northern Arizona.
Great place.
Incredible
I've
for
been there.
water skiing, cliff
Yeah.
jumping, all of that. But we flew into Las Vegas, and then we drove there. So we flew into Las Vegas. We stayed one night at the Circus Hotel, and we just kind of had fun. What do you do if you're a kid in Las Vegas? Well, you don't gamble. You don't. you do buffets and you do roller coasters.
Right.
That's kind of it. Maybe a magic show. So we went to the Stratosphere. If you don't know what the Stratosphere is, think of the Space Needle, but in Las Vegas. And on the very top, they have this ride called the Big Shot. I think it's still there. The Big Shot is 300 feet vertical. It goes straight up, okay, on top of the Stratosphere, on top of the building. So it's like the highest building, I think, in Las Vegas, or one of the highest, okay? We get to the very top. We're on the roof. Then, there's a guardrail on there. And then we get in this roller coaster that's going to pull 3 or 4 Gs going up. And then you free fall going down, and you can't see anything other than the city. And we do this at night. So I am a very scrawny, thin, light kid, okay? I'm 11 years old. 4 Gs is a lot for a kid to handle. I wish we bought the picture because here's what happened. The ride goes off, right? It says, and they trick you. They go, all right, we're going to launch in 10, 9, and then it just launches. They never actually do the right countdown. Spoiler
All right.
alert.
Yeah.
And so it catches you by surprise. Well, it caught me by surprise. And the gravitational force was so powerful, enough blood came out of my head that I passed out. Okay? I could not handle the volatility, so
sure.
to speak. And then when I gained consciousness at the top, because I was kind of scrawny and not really in my seat, I mean, I was safely in my seat, but I didn't know that. I felt like I was falling out of the ride because I was lifted up in my chair, leaning forward, thinking the ride broke, and I'm about to fall to my death.
That sounds
And
terrifying.
then it free falls 200 and some feet before it catches and then throws you back up again. Okay. Why do I say this story? The reason is the market is very similar to this. Most people I have met have most of their assets in the market, and they're very happy about the upside volatility. They love the growth, but they have forgotten what it's like to lose your money. They have forgotten what it's like to be in a 2001 and 02 situation, which is a very normal situation for a market crash, or a 2008 financial crisis where it goes down very sharply, where you think the banking industry is going to collapse. The pandemic wasn't really that big of a market crash. It was a quick crash, but we printed a lot of money, so it recovered quickly. And all the money that the Fed printed basically made its way into the stock market, and all was well. And then we had a slow inflationary crash, which was difficult in 2022, 2023, but that wasn't that big of a deal because, again, we were printing money and inflation. We still recovered. It wasn't the end of the world. Those aren't normal crashes. They can be much worse than that, and we have forgotten what that's like. And if you look at the last 10 to 15 years, we are now used to a crash only lasting a couple of months, and that we're averaging 14% returns on our portfolio. That is not a normal situation. The last time I can think of that being the standard was 1990 to 1999. And then what happened in 2000? The reason why I bring this up is greed is a very powerful emotion, and FOMO, fear of missing out, is a very powerful cognitive distortion that prevents people from seeing reality as it is. all of that upside potential you have has an appropriate amount of downside risk. And so as people enter towards retirement, as they're looking towards keeping their money and staying rich, typically 5 to 2 years before you retire or when you retire is when you start locking in your gains and start moving some assets towards something that's protected but still has growth potential. So not necessarily CDs that are at a fixed rate. Like if the markets boom, you want to capture a lot of that growth. But if the markets go down, you want at least a part of your portfolio to not go backwards so that in the next year or in 2 years when the markets start to recover, that you're still participating in that growth. You just didn't go backwards.
Yeah, that makes sense.
It's not about getting rich. If you're going to retire, it means you've already become rich. It's about staying rich. It's about lowering the range or threshold of the volatility, the ups and downs, so you have a more predictable threshold and that you can have a more predictable plan, a more predictable portfolio, and know how to more appropriately navigate through these treacherous situations. So, hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.